Good afternoon, everyone. We thank you all for your time today to attend our webinar. The topic is about the severe beating the small caps have got since the beginning of this year, and our prognosis for the future, and how investors, more importantly, how investors should navigate this uncertain phase. We sincerely hope that you will find this session interesting and informative. Before that, we will take a few moments to introduce our company, TrustLine Holdings, and the key speaker for this session. TrustLine Holdings is a 2-decade-old SEBI-registered alternate asset management company. We are based out of Chennai. We are a small cap specialist and a very meticulous practitioner of value investing. Our asset under management is around 1,000 crores. We have built a very enviable client base of C-level leaders who form majority of our 600 plus clients. Today's session is going to be anchored by Mr. Arunagiri, who is a founder, CEO, and Chief Investment Officer of TrustLine. Arun comes with more than 2 decades of small cap investing experience. We would certainly encourage all of you to ask questions at the end of this session. I shall now hand over to Mr. Arunagiri. Over to you, Arun.
Good morning, everybody. Thanks, Govind, for a very quick and brief intro. And welcome all of you to this session. And thanks a lot for joining this session on a weekend. Really appreciate that. And this session is coming at a very, very interesting times for the markets. Markets are, grappling with kind of a macro environment which is very fickle, fluid, volatile, and very unpredictable and uncertain times, right? So in this kind of uncertain times, starting from stagflation fears in the US, ups and downs in China stimulus, and slowdown fears in India, whatnot. There are so many factors, and there are so many moving parts, variables that are impacting the markets in this very uncertain times. So putting all this together, I think we couldn't have chosen a better time to do this session than now. And so as a result, I am also, because it provides a great opportunity for me to respond to many questions which investors may have in these, market challenging times for the markets. As a result, my plan is not to spend too much time on these slides. Of course, we'll spend on the presentation. Probably we'll keep it brief and short. But I would like to spend more time on the Q&A session, which will follow the presentation, where I would expect and encourage our prospects and our participants to ask many, many interesting questions for which we would love to respond. That's the way we would like to keep this session. That's a plan. With this broad outline out of the way, let me jump straight into the presentation. I will start this presentation with the genesis of the correction, right? A lot has been written and discussed on the nature of the correction and the trigger for the correction, which we have been seeing for the last 6 months. So, and it's been widely covered in social media and mainstream media, and what caused the correction, what triggered the correction, and what is the nature of the correction. So I would not like to dwell too much into this correction, except giving a brief warm-up just to set in the context. And before we really spend more time in terms of what kind of recovery this market is likely to see, what shape the recovery is likely to play, and that's where I would like to spend more time. So with that, I think let's look at the correction very briefly. I think all of us know that the market peaked sometime in last week of September, right? After that, it has been a one-way fall starting from last week of September to mid of March. Now, the first leg of correction, it got triggered by so-called this China reallocation trade. And this happened because there were hopes that the large stimulus which the government would announce from China would probably trigger a huge recovery for Chinese economy. As a result, money started moving out of some of the emerging markets, in particular India, into China. So that triggered the first leg of correction. But mid into October, this fizzled out because the stimulus which the market got from China disappointed the investors. As a result, I think the trade slowly started reversing. So our Indian market kind of stabilized in October, but that recovery or stability didn't last for too long. Starting November, the hopes of Mr. Trump coming back and winning his election, the so-called Trump trade started playing out. That became the second leg of the correction. That triggered the second leg of correction. The so-called Trump trade is nothing but the strengthening dollar index and the rally in US 10-year yield, which on the hopes of Trump's tax policies, tax cuts, and deregulation. So which the investors thought that's going to really boost the US economy. As a result, money started moving from emerging markets to US. So this trade started playing from November. So our correction started getting deepened because more money started moving out of India. FIs started selling more. This particular trade, went till mid of Jan. And so this lasted till Jan mid. And then you had, Trump administration taking the presidency. And that's when I think the tariff war started, and that became again a pressure point for the markets, and the correction started accelerating. It's got more fuel and momentum for the markets to correct deeper. So successive events which played out in terms of market correction finally in the last leg ended in a huge fear cycle. Because, you had 3-4 bad events coming and FIs continuously, relentlessly selling. Finally ended up in the last leg of fall, which is more like a capitulation. The market simply collapsed on fear, irrational fear, which is what we witnessed in the month of February until mid of March. Just to give you a sense of numbers in terms of how much the kind of fall we saw in the markets, small cap index at the index level fell over 30% since the highs it hit in September. That's a kind of fall at the index level. And at the stock level, many stocks came down crashing by 50-60%. And in terms of FI numbers, it was massive outflows. Since October, the kind of numbers is the outflows from FIs was over $30 billion. India has not witnessed such a massive outflows for very long time. So this is the backdrop in which the correction happened. This much is known. All of us knew that the correction was very sharp and steep, and it was brutal, right? Especially in the broader small and mid cap. Now, in terms of recovery, which we're witnessing since mid of March, right? Now, currently, we're witnessing a big rally in both Sensex, mid caps, and small caps. Investors are genuinely asking some very interesting questions. The reason why they're asking these questions is because the recovery looks really serious one. It doesn't look very shallow. It doesn't have, it doesn't look like a dead cat bounce. I'll tell you why it doesn't look like a dead cat bounce. The investors are wanting to know whether this is going to be what shape the recovery will take hold. Whether it's going to be a V-shaped recovery, or is it going to be a time correction with a range-bound movement, or this momentum is likely to shift into large caps, which is what the mainstream narrative is, that small caps probably will go through a sluggish phase and the momentum will shift to large caps. What kind of recovery this particular phase the market is likely to see, that's what we are going to discuss. Now, why investors are asking this serious question is because, if you look at the recovery, it's quite sharp. Small cap index, let me tell you, from the lows, it is up 12%. And in the last week alone, it's up 8%. And this is not happening. It is not happening in isolation. If it's happens in isolation, probably you could call it as kind of oversold market, seeing a bounce and all that. But let me tell you what additional things we are witnessing in the market is that you look at the currency, it's up 1.8% in March itself. Indian currency, it's now almost 85. We were very close to 87, right? Not very long time back. And you look at debt funds, FI flows in this month is over $1 billion in debt funds after a very long time. And for the last 2 days, FIs have turned positive. And that's not a small number. The last 2 days, it is about $1.2 billion. This is happening after a sustained selling by FIs. So all these put in context, plus there is a real change in the macro environment, which I'll discuss in detail. So all these put together, plus the rally which you're seeing in this Indian markets, investors are seriously, wanting to know whether this recovery is a serious one, whether it will take, what kind of shape and what kind of nature it will have. All that they want to know, because there's also a change in the environment, macro environment, post mid of February or March. If you go through this change of environment, the first one is seeing a lot of signals on reversal of Trump trade. There's a kind of, market is kind of disillusioned with Trump's policies. In October, November, the markets were betting on US exceptionalism with Trump coming back. And as a result, money started moving out of EMs, emerging markets, to US. The hope was the focus from Trump will be on tax cuts and deregulation. But disappointingly, what market found since mid of February is that there is more noise on tariff and trigger for tariff wars than the focus on tax cuts and deregulation, which market got disappointed. As a result, there is now a fear of stagflation. Stagflation primarily uh, means slowdown amid elevated inflation, right? Economy is slowing down a bit, and then inflation is elevated, which is what the market is worried. So the traders started reversing for Trump. The Trump trade, which dominated from November to, I would say, mid of February, kind of reversing. I'll tell you how. The signals. What you need to look at is the dollar index as well as the US yield, which primarily triggered the second leg of correction in November. Look at those numbers. Dollar index, which hit a high of 109, is now all the way back to 103 plus. And US yield, treasury yield, which hit all the way almost 4.8, is now all the way back to 4.25 to 4.3, right? And you look at Europe, the markets are optimistic about the debt break, which the Germany is talking about. And China trade has come back. The Chinese tech index is up 30%, right, in this quarter after the DeepSeek moment. And look at S&P 500, it's down 8% from mid of February. NASDAQ is down 12% from mid of February. At the same time, Hang Seng is up by 5% the same time. And even India is up 1% from mid of February. So this is telling you that the macro environment has changed. Investors are now moving money out from performing markets to underperforming markets like emerging markets, China, and Europe. So this, coupled with the currency strength in India and the FII flows turning for India, plus the high frequency indicators which are turning for India GDP, all these put together, I think this bounce looks like a serious one, right? So the investors are right in asking, looking at these answers for recovery is a genuine one, because it doesn't look like a shallow one. It's quite a serious one in our view. Now, if you want an answer, in terms of understanding this and then looking at what is likely recovery for the markets in the coming months, what I would do is I'll pick 3 correction cycles in the last 2 decades, right? And see if there is any pattern which is emerging, and whether from that pattern one can learn a lesson in terms of how the recovery is going to take place in the coming months. There are 3 down cycles, correction cycles. I'll list out all these 3. One is 2006 May, in which in all these 3 cycles, let me tell you before I move to the next, in all these 3 cycles, without exception, the single small cap index crashed by 25 to 30% in all these 3 correction cycles. One in 2006, the second one in 2016, and the third one 2022 Jan, right? Look at the first one, which happened in May 2006 on fears of Fed tightening. The small cap index fell by over 30% plus. And look at the second one, which happened in Jan 2016. Small cap index on China slowdown and yuan devaluation fears crashed by over 25%, right? And third one, in 2022 Jan, you had a similar fall in small cap index because of a geopolitical situation of Russia-Ukraine crisis. In all these three cases, it was, you look at small cap index, which fell by close to about 25-30%. And if you look at the recovery in the next 12 months, it almost doubled. The small cap at the index level doubled in all these three cases. And the other common factor in all these three correction cycle is that none of this were triggered by domestic reasons or domestic crisis. All of them were triggered by external events. 2006, Fed tightening. 2016, China slowdown, yuan devaluation. 2020-22 is geopolitical, right? In all these three cases, it was triggered by external events, right? So what is the understanding one gets out of all these three cycles is, one, in bull market, you will have a very serious correction. It is given. And it is a bull market correction. It can happen and it can be very scary. Like screens, if you look at February, March, the kind of capsulation which we went through, the screens were really, really scary. And it really, when the fear cycle plays out, it really gets into your nerve. And that's how bull market corrections happen. And it has always been a buying opportunity when India corrects for non-India specific reasons. It's a uniform thing without exception. When India corrects for non-India specific reasons, it's always been a big buying opportunity, right? You have seen all these three cycles. Like, for example, 2018, the crisis was domestic. We had a huge NPA cycle. We had a huge balance sheet issues with banks. And we had a crisis which got triggered by IL&FS. And then got accelerated by very, very, very poor poor budget from the finance ministry in 2019, right? All these I think the correction cycle in small cap went for about 3.5 years. So those things can happen, but especially when it gets triggered by domestic crisis. But look at the domestic scenario today. The macro, couldn't have been more healthy for India at this point of time. You have, of course, there is a small slowdown, cyclical slowdown in the economy in the last 6 months for various reasons which are well debated in the media. But look at the macro parameters. You have, be it fiscal or be it current account, be it currency, be it forex reserves, or your corporate balance sheets, bank balance sheets. You couldn't have been more healthier than this. So India macro is absolutely robust and pristine. Given at this environment, when you have a correction which gets triggered by external events, I mean, it is a, in our view, it's a sitting duck for in terms of buying opportunity, right? This is what we would say. Before concluding, I would like to leave some thoughts. In terms of recovery, I think as we have seen in the last 3 correction cycles, one would be tempted to draw out a conclusion that this recovery too will be a V-shaped recovery, right? But in our view, I think given the kind of valuation at which the broader market is trading, even after the correction, it is quite at a premium to historic averages, right? At the small and mid cap levels. So given the kind of valuation compared to earlier correction cycles, it's very unlikely that the market will do a V-shaped kind of momentum-driven market. The kind of momentum we saw in the last 2 years in broader market is unlikely to repeat. Having said that, though it is unlikely to be a V-shaped recovery, but the market can turn very, very stock specific. So stock pickers will have a very good time, and stock pickers will get rewarded if they are sitting on the right stocks, right? And one more observation, which is very crucial, is the last 2 years momentum stocks, be it defense, PSUs, railways, and manufacturing, the kind of those hype cycle they went through, those stocks may not suffer a huge price damage because of the overall bullish environment, but it'll go through certainly a huge time correction. Very unlikely that they will give you many meaningful return or material return in the coming period. So for the investors, the most prudent approach is to take a very balanced stock specific approach to navigate the period in the medium term. That's what I would say. In terms of headwinds, of course, there are some headwinds which you need to be very conscious of. Reciprocal tariff and moderation in earning growth in India are likely to keep the market in check. That said, the positives are very high level of cash in MFs, sticky structural flows from domestic investors, and encouraging long-term growth outlook for India. So with this, let me conclude. Before concluding, let me leave some thoughts on the overall long-term investing approach. It will be very, very useful for investors who are looking at, what are the challenges really in terms of sitting tight in a very turbulent market. I think this one slide, I think it's a very favorite slide for us, in which we capture this investment return of a fund and investor return. There's a huge gap. What stands between investor return and investment return, right? Investment return, when we say the fund return, or the stock return, which is delivered, it has delivered over a period of time. Investor return, how much of it is captured by the investor? You would be surprised to know that less than 1% of the investors capture the full return of investment return. Less than 1%. What stands out as a challenge between these two is the behavioral gap. Investors are tempted to time in, time out. Investors have this mistaken notion that money has to be working all the time in a linear fashion, and they underestimate the challenges required to time the bottom and time the top. And ultimately, I think investors, have a tendency to get trapped into narratives. I think our experience shows that, you should, give least regards for the narrative and put more focus on the price action cycles. So that's what I would say. The power of staying invested, as Mr. Warren Buffett had repeatedly emphasized, inactivity strikes as an intelligent behavior. So staying put gives you a lot of rewards over a long period of time. Just to give one more example in terms of staying invested, Apple increased more than 60 times between 2002 and 12. And out of these, 48% of the trading, all trading days, it fell. So it's never a straight path up, Morgan Housel. And the last slide, which I'll leave this thought with you. Understanding both the power of compounding and the difficulty of getting it is the heart and soul of understanding a lot of things. Our favorite Charlie Munger. Thanks a lot once again for everyone. Thank you.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.